Hello everyone, we are Group-4 and we are here to present a short analysis of major macroeconomic events that happened in year 2020. So moving ahead, let us first see what were the impacts due to pandemic. Some impacts on nationwide supply. As we all know, the lockdown led to a complete nationwide factory shutdown for all non-essential commodities. Moreover, the travel restrictions led to a huge disruption in logistics. The function of industries that were already functioning faced a huge input crunch. Moreover, since there was reverse migration which impacted the availability of suitable labor, and as there was loss of sales, that led to shutdown of lot of industries and MSMEs. This was not it. There was also a huge demand shock on Indian economy. Some major impacts on nationwide demands were: lockdown led to severe cutting down the spendings of non-essential items, as no common man was ready to spend money on items that are non-essential. Moreover, there was a reduced global demand, which impacted the Indian exports. And as we all know, falling revenues for companies led to pay cuts and layoffs. So, looking at the trend, how COVID-19 spreaded, when it was only in China, there was a disruption of Chinese supply chain, which was specific to just China, which was an external supply shock for certain domestic sectors. Then, as the coronavirus spreaded across the rest of the nation, there was a weak global demand, which also led to an external demand shock. As the COVID-19 started to spread across the nation, there was lockdown for consumers and firms, which led to a domestic supply and domestic shock. So, as our analysis shows, COVID-19 lockdown caused a supply shock, which was then followed by a demand shock.
Now, let us analyze pandemic impact on GDP, which is gross domestic product, and it is equal to total value of final goods and services produced in the domestic territory of a country during a financial year. We know that GDP is a measurement of everything that is produced, but it can also be measured as a component of total expenditure. And in it has four major components that are private final consumption expenditure, expenditure on capital goods, government final expenditures, and net exports, that are total exports minus total imports. The graph shows the quarterly GDP of the country with its all four components. We have all heard the news of GDP declining after the pandemic. But if we closely look at the graph, we can see that the quarterly GDP of the country was in a downturn since the start of first quarter in financial year 2019. And the reason for it was that the exports and investment were shrinking, and it was increased government spending that improved the progress to compensate for decreasing private sector demand. And with the onset of COVID-19, India recorded its highest dip in quarterly GDP, which declined by minus 23.9% in the first quarter of 2021. These readings in this graphs are inflation adjusted, as they are of real GDP, and it is calculated at 2011-12 prices. Due to nationwide lockdown, which led to disturbances in supply chain and stopping of production unit across the country, it led to 47.1% drop in gross fixed capital investment. Also, during the same time, the private consumer spending also declined by 26.7%. And due to declining international trade, the exports dropped by 19.8%, which had already been shrinking for last 4 quarters. And as compared to exports, the reduction in imports was much more significant, as it decreased by 40.4%, which was mainly due to declining domestic demand as well as oil prices. As an attempt to boost the economy, the government stepped in and announced relief packages to provide financial boost. Subsequently, it incurred unplanned expenditure, and as a result, government final consumption spending rose by 16.4%.
Depreciation of Indian rupee during the pandemic. The price of crude oil has always had a significant impact on the value of INR against the USD. During the pandemic, the industries were shut and the fuel consumption fell rapidly. The crude oil prices experienced the sharpest drop, that is below $30 per barrel mark. Many countries, including USA, faced tightening of financial conditions. Also, shale industries had to sell off their assets. Due to these reasons, the dollar liquidity reduced, leading to the depreciation of all the global emerging currencies, including the Indian rupee. In March 2020, the Indian market experienced an FPI withdrawal of around $16 billion, that is the largest monetary withdrawal up to date. These reasons lead to a depreciation of over 4% in the Indian rupee as compared to the US dollar, currently corresponding to 72.85 Indian rupee.
So let's now talk about an important term in macroeconomics, which is inflation. Inflation is a general rise in the price level in an economy over a period of time which reflects a reduction in the purchasing power per unit of money in that economy, which is basically a loss of real value in the medium of exchange and the unit of account within the economy. So basically this means that with the rising rise of prices of products in the economy, the purchasing power of the economy decreases. And this is what inflation means in macroeconomics. Next, let's see a event which was influenced by or related to inflation in the Indian government. So during the lockdown, there was inflation on several products and most importantly on the lower end of the purchasing power of the society, that is the rural and farm workers. There was high inflation during the beginning of the COVID lockdown in that we had in our country. So due to this, there was an easing of inflation on the rural and farm workers in our country. So the retail inflation was at a point where it was 6 and 5.86% for the rural and farm workers respectively, and which was reduced to 3.25 and 3.34% by our government during December. According to the government data, the current inflation according to the cost price index of agricultural laborers and cost price index of rural laborers is 2.97% and 2.96% in the positive for these communities. The reason for reduction was due to the fall in prices of pulses, onion, potato, cauliflower, brinjal and other vegetables. And due to this fall in prices, the inflation was also reduced by around 3% as we saw before. Now these factors have now further helped the rural and farm workers situation, as now their purchasing powers has improved, and this has proved a good decision by the government to reduce such hardships on the lower classes of society.
We will now take a look at the reverse repo rate and the impact the changes in it bring in the economy. The reverse repo rate is the rate at which the central bank of a country borrows money from commercial banks within the country. It's a monetary policy instrument which is used to control the money supply in the country. An increase in the reverse repo rate leads to a decrease in the money supply, and the reason for that is that the commercial banks get more incentives to park their funds with the RBI, whereas a decrease in the reverse repo rate leads these banks to draw back their funds from the RBI and increase the money supply in the economy. The impact of changes in the reverse repo rate in 2020 can be seen here. The reverse repo rate at the start of the year 2020 was standing at a whooping 4.9%, which was decreased to 4% just at the beginning of the lockdown, and then it was further reduced to 3.35%. This step was taken to increase the money supply in the economy, which would lead to an increase in the consumption and investment in the economy, which would lead to an increase in the aggregate demand in the economy, so that the economy can bounce back from the downfall it has faced. The change that it brought about was that the money supply M1, which includes the cash and checkable deposits, it was standing at 41,176 billion INR in the starting of March of 2020, and it had changed to 43,483 billion INR by the end of November, which can be seen as a change of 2,307 billion INRs, which is a really great amount, and which would help the economy to really bounce back from the downfall it was facing.
Next is cash reserve ratio. CRR is share of a bank's total deposit that is mandated by the RBI to be maintained with the latter in the form of liquid cash. CRR is one of the major weapons in the RBI's arsenal that allow it to maintain a desired level of inflation, control the money supply, and also liquidity in the economy. Reduction in cash reserve ratio. RBI decreased CRR of all banks by 100 basis points to 3% of the net demand and time liabilities. This will release around 1,37,000 crore of primary liquidity through the banking system. In addition, reduction in daily CRR maintenance requirement to 80% from 90%. This will allow banks to release money into the economy and help them to raise capital and money. This was done in view of the ongoing difficulties faced by banks in terms of social distancing of workers and consequent pressures on reporting requirements.
Surge in money supply. A surge in money supply has been observed during the pandemic. In fact, it has been the highest since 2013 and with an increment of 6.7% from the previous year. Rise in money supply is usually seen as indicator of growth in consumption and business investment, but it is highly unlikely in this case. It rather reflects recent increase in cash withdrawals by people to safeguard themselves against salary cuts, job losses, etc. Savings and current deposits fell by 8% as people are trying to hoard money, leading to growth in currency notes held by public and a surge in currency circulation. However, when money supply has been highest since 2013, the gross capital formation has hit its lowest in 7 years and continues to decrease. The investment fell by 7% during the early year and are expected to decrease even more as the private fundings are being pushed to savings instead. We can clearly see that even with the money supply at its peak, the economy is frozen and no activity during lockdown led to no new investments. In situations like this, RBI can engage in open market operations by capitalizing the banks to decrease the interest rates, allowing businesses to borrow some money at lower interest rates and which might prevent small businesses from collapsing and maintain liquidity.
Hi, this is Ritvik. Now let's discuss impact on startups and micro, small, and medium enterprises. All these enterprises that generate more than 90% of their jobs employ more than 114 million people, and this obviously contributes 30% of GDP in India. All these enterprises are at risk of serious cash crisis due to the lockdown and its extension of the lockdown. Many of these enterprises have loan obligations and monthly EMI payments. Many of them can disappear if the cash cycle is disrupted due to this lockdown, and in such a situation, there is a fixed cost to them. They need a moratorium for mortgage repayment. Also, RBI has released funds to non-bank financial companies, also in which some of them all fund these enterprises. On top of that, these companies are looking at huge losses because of the impediment to the movement of perishables. India cannot achieve truly sustainable growth without a thriving micro, small, and medium entrepreneurship sector. The COVID crisis also tests the resilience of Indian startups. Startups must rely on cross border financing. Some founders are seeking their business shutdown, accounts receivable are skyrocketing, and venture companies need to take painful cost cutting measures like removing money from the jobs, etc. Government needs to make funding available in the sector because all these venture capital firms may take some time to come and support due to limited global capital flow. Thank you.
Moreover, the various statutory compliances under RERA, which is Real Estate Regulation and Development Act, were given concurrent extension.
Now moving on to the measures for Insolvency and Bankruptcy Code (IBC). The threshold of default under the IBC was increased to 10 million to prevent insolvency against MSMEs. All the loans for COVID-19 were excluded from the definition of default. Admission of fresh insolvency cases for default, which arose after financial year 2019, was suspended for 6 months, with an aim to restrict companies from being forced into solvency. Discussing about the reliefs provided by the Government of India, a relief of rupees 17,000 crore was released for NBFCs, that is the non-banking financial companies, as a part of liquidity infusion and partial credit guarantee scheme, and a relief of rupees 90,000 crore was released for the purpose of liquidity infusion DRISCOMs against the receivables guaranteed by the state governments.
Let us discuss about tax measures. Tax deduction at source (TDS), rates for non-salary defined resident payments, and tax collection at source (TCS) rates were decreased by 25%, which is beneficial for the taxpayers as it allows them to pay taxes at a lower rates and hence saving money. The due date of all income tax return for the financial year 2019-20 was postponed till 31st December 20. Various relaxation and due date extensions were provided under Taxation and Other Law Ordinance 2020.
We will now take a look at the points that we would like to advise to the government so that the economic condition of the country can be improved. The first point that we would like to point out is investing in infrastructure enhancement, which would lead to generate more jobs in the country, which would eventually lead to a higher demand for goods and services produced by micro, small, and medium enterprises, which would lead to an increase in the GDP of the country. Another point that we would like to propose to the government is emphasis on healthcare. The reason for that is to prevent any such pandemic related issues in the future, so that the country can fight back such issues with much more resilience, and such huge capital and human losses are not seen in the future. The government can explore borrowing opportunities in countries with low interest rate, and they can try to reduce their borrowings from countries that are having high interest rates. For example, in Spain, the interest rate has been reduced from 1.66% to 1.3% in the November of 2020. Another proposal that we would like to give to the government is to reduce the expenditure on revenue and increase the expenditure on resources. And the reason for that is that the demand for products is actually fallen down in the period of lockdown and is actually increasing. In this time, it has not reached back to the original level which it was at the beginning of the year. So the government should take a chance at this moment and reduce its spending on revenue creation so that it could invest more in asset creation in the upcoming year so that more infrastructure and more employment can be created in the country.
Next is improving the ease of doing business environment, in which we firstly propose that there should be tax cuts on both individual and companies earning, as we can understand that it would take some time to come back to normal in terms of the sales of goods and supply of services. Therefore, we can expect that revenue income should be low and the main advantage should be offered to those who are most affected by the pandemic. Also, this is a good time to reform tax structures which can help us in recovery. Currently, we have an inverted obligation system where input taxes are higher than output taxes. This rates needs to be rationalized. Next is we should look at stabilizing the financial sector, where firstly there is a need for reform in corporate taxes for international banks which are having their branches in India. There is a higher tax which is being charged on these banks as compared to their Indian competitors. Currently, foreign banks are paying 40% tax as compared to 30 to 35% being charged on Indian banks. This reform would help in promoting growth and incentivizing other international banks to come here. Also, if large corporates can be granted the license under strong regulation and guidelines, it can help in bringing more capital, expertise, and experience to the banking sector of the country. Thank you.